Okay, so imagine this. Some analysts are predicting certain tech stocks might see a jump, maybe over 30%, just within the first year of a new Trump administration.
Wow, yeah. That's definitely a bold prediction.
It is. So let's unpack this a bit. This deep dive, we're focusing specifically on how the Trump 2025 agenda could potentially shake up technology stocks.
Right.
We've looked through an investor analysis report, really trying to pull out the key insights for you. We're zoning in on four main policy areas.
Okay, what are they?
So immigration, trade, especially with China, then AI, how it might be regulated, how it might be funded federally, and finally, tax and antitrust policies.
Got it. And what's really fascinating here, based on that kind of analysis, is the potential for some, well, pretty significant shifts grounded in those core America First ideas.
Like what specifically?
Well, think about potentially tighter rules on skilled immigration, H-1Bs and such, maybe ramping up of trade tensions with China.
Right, tariffs again.
Possibly, yeah. And then maybe a move towards less regulation for tech, especially, in AI, alongside maybe an easing of antitrust enforcement and possibly some big tax cuts.
Exactly. And this isn't just like abstract policy talk. We want to get right to the core of how these potential changes could impact who wins and who, well, faces new challenges in the tech world.
Makes sense.
Think of this as your shortcut, your way to get informed on these pretty complex shifts. We'll try to highlight the potential aha moments without burying you in details.
And it's important context that this analysis we're looking at, it's coming from a recent investor report. So it's definitely got that financial perspective, that market lens.
Right. It's about how investors might see these potential changes.
Yeah. And if we kind of connect this to the bigger picture, the report seems to suggest some interesting potential trade-offs.
Trade-offs like?
Well, maybe higher costs, say, in the short term, and maybe more geopolitical uncertainty. But the flip side, the potential long-term gain could be more resilient supply chains, maybe closer to home, and perhaps a lighter regulatory load on the tech industry itself.
Okay, interesting balance there. All right, let's dive into the details then, starting with immigration policy, which, this is huge for tech, right? They rely so much on global talent.
Absolutely critical. And what the report anticipates is, well, a return to and maybe even a strengthening of the stricter requirements for H-1B visas. The ones we saw hints of, or more than hints of, in the previous Trump administration.
For anyone who needs a quick reminder, H-1D, those are the temporary visas for foreign workers in specialty jobs, right?
Exactly. And the expectation is that companies might face higher prevailing wage thresholds. That's the minimum they have to pay these H-1B workers. And maybe a narrower definition of what even counts as a specialty occupation.
It sounds like potentially a real increase in labor costs for companies using these visas. And maybe fewer approvals overall.
That's the potential impact, yes. The report notes that the Department of Labor is already sort of signaling plans to push those H-1B wage levels back up, maybe recalibrating to those more restrictive 2020 calculations.
Which raises that big question, how do tech companies get the talent they need then?
Right. And the report also suggests we might even see a return of, say, outright bans on H-1B entries or maybe changes to the lottery system. That's how they currently award these visas because demand is so high.
Changes like what?
Well, one idea that's been floated is awarding visas based on the highest salary offered, which, would likely benefit the really big tech companies, the Metas, the Googles, who can afford to pay top dollar.
And it's worth remembering just how crazy the demand is. I think back in March 2023, there were, over 780,000 registrations for that lottery?
Insane numbers. And even with some new anti-abuse rules bringing the FY 2025 entries down closer to, say, 480,000.
So huge.
It's still massively over the 85,000 annual cap.
Yeah.
So yeah, this really underlines how the tech talent crunch could potentially get even worse.
And it's not just the temporary H-1Bs, right? What about green cards, the permanent path?
Yeah, the outlook there, according to the report, isn't expected to improve either. It doesn't foresee any increase in that roughly 140,000 annual limit for employment-based green cards. And there's even talk of a potential shift towards more merit-based systems, which might still limit the overall numbers.
Right, and that could have knock-on effects, couldn't it, on things like OPT, optional practical training.
Exactly. OPT allows foreign STEM grads, science, tech, engineering, math, to work here for a bit after studying. Crucial pipeline.
Especially for AI talent, right, out of universities.
Hugely important. And there's talk of maybe stricter oversight, potentially even scaling back or eliminating the STEM extensions for OPT. We're talking about, roughly 80,000 foreign students getting OPT each year, a lot of them in computing fields. Losing that flow would be significant.
And there was something else. H-4 visas for spouses.
Ah, yes. The potential rescinding of H-4 EADs, the work permits for spouses of H-1B holders. That could really make the U.S. less attractive for senior foreign engineers. If their spouse can't work, maybe they look at Canada, maybe Europe instead.
And for countries like India, with those massive green card backlogs already?
The report doesn't really offer any glimmer of hope there, no indication of relief in sight based on these potential policies.
Okay, so let's connect the dots. What does all this mean for that crucial AI talent pipeline? It sounds complicated, like maybe good for some, bad for others?
It's definitely mixed. On one hand, maybe domestic tech workers see more opportunities. Maybe companies invest more in training U.S. grads.
Okay, that's the potential upside.
That's a potential positive spin. But the risk, the analysis suggests, is significant talent shortages for the big players, Google, Meta, Microsoft, and also for startups. And that could genuinely slow down product development, cloud expansion, the engines of growth.
Plus rising labor costs.
Likely, yes. And as we touched on, maybe the biggest companies just end up absorbing most of the limited H-1B slots because they can pay more.
It's interesting. The report mentioned nearshoring, like as a workaround.
Yeah, more companies may be opening R&D centers in, say, Canada or Mexico, where immigration might be easier. We actually saw a bit of a boom in Canadian tech hubs during the first Trump term. Could happen again.
And short term, those higher labor costs, pressure on margins for IT services firms, anyone really reliant on H-1Bs.
For sure. Companies like Amazon, Google, IT consultancies, they could feel the pinch. Although maybe, just maybe, the stricter rules mean the talent that does get through is even higher caliber. More PhDs, more specialists. That's a possibility too.
And what about the idea of cracking down on H-1B abuse, like Elon Musk has talked about with outsourcing firms?
Right. The report suggests we might see more targeted crackdowns on, lottery fraud or companies perceived as abusing the system, while still trying to allow legitimate high-skill hiring. The big question is, can they thread that needle? Or does it just become a generally restrictive environment?
Okay, so if we were to do a quick SWOT analysis, strengths, weaknesses, opportunities, threats for the tech talent pipeline under these potential policies, what would that look like?
Okay, quickly. Strengths. Maybe more jobs for U.S. STEM grads, less reliance on foreign labor driving automation, maybe a higher bar attracting top-tier global talent if you can get in.
Weaknesses.
Higher labor costs, definitely. Bureaucratic delays, a potential brain drain if grads go elsewhere, companies struggling to fill roles, hindering growth.
Opportunity.
Maybe companies diversify where they hire, like nearshoring, more investment in upskilling U.S. workers, maybe more innovation in AI developer tools to boost productivity, and long shot, maybe it pressures Congress to actually update immigration laws eventually.
And the threats, the big risks.
Innovation slows down if talent shortages bite hard. The U.S. potentially loses ground in the global AI race. Other countries actively poaching talent turned away from the U.S., plus legal challenges, uncertainty, HR headaches for companies, and maybe a reputational hit appearing unwelcoming could hurt diversity goals and global image.
Okay, that's a lot to digest on immigration. Let's shift focus now. Trade and China policy. This feels like another area where we could see some pretty asserting moves.
Definitely. The report signals a likely, significant escalation of U.S.-China economic tensions, and that could have major ripples through tech supply chains, tech markets, everything.
So, back to tariffs, export bans, and maybe a stronger push for reshoring, bringing manufacturing back.
That seems to be the playbook outlined in the analysis, yes. Tariffs, tighter tech export controls, and strong incentives for making semiconductors and other electronics here in the U.S.
And the tariff levels being talked about, these sound serious.
They are. Trump has publicly mentioned at least 60% on all Chinese goods. The report details a potential rapid rollout. Maybe 10% in Feb 2025, 20% in March, another 34% in April, hitting around 54% cumulative.
Wow. 50+% tariffs. That'd be devastating for companies like Apple, right? Still assembling so much in China.
Hugely damaging. It could force massive price hikes for consumers here or just crush their profit margins. And yeah, they're shifting some production to India, Vietnam, but China is still a massive chunk of revenue, maybe 17% in 2024, and an even bigger slice of production.
And what about chip companies? NVIDIA, AMD.
It's like a double whammy for them. China is a key manufacturing step through partners like TSMC doing packaging there, and it's a huge end market. We're talking maybe 20% of NVIDIA's sales, 24% for AMD, even more like 27% for Intel in 2024. Those tariffs hit hard.
Plus the export bans on advanced AI chips. like NVIDIA's A100, H100,
Yeah.
those likely stay or get tighter.
The report strongly suggests that, yes, maintaining or even tightening those Biden-era bans seems very likely. Although, interestingly, the report mentions a Trump administration reversal of a specific Biden rule about exporting AI cloud computing services to China.
Why that specific reversal?
Potentially a nod to concerns from U.S. cloud giants, Microsoft, Amazon, Oracle. They probably didn't want the headache of policing who runs their cloud GPUs. But the overall trend, definitely towards tighter tech transfer controls going to China.
So to counter that, the strategy involves boosting domestic production, building on the CHIP Peace Act.
Exactly. Incentivizing domestic semiconductor and tech hardware production. The report mentions TSMC's huge $100 billion plan for 5 new chip fabs here in the U.S., announced back in March 2025.
Frames that as national security, right? Making chips here.
Absolutely. But it's worth noting, TSMC's stock apparently dipped on cost concerns about building here. And Trump himself has kind of criticized the CHIPS Act as unnecessary subsidization. He seems to prefer broad tax cuts and higher tariffs as policy tools.
So maybe reviewing the CHIPS Act grants.
The report suggests that's happening, yeah. Aiming to remove things like diversity and inclusion requirements tied to those grants. Plus, expect more friendly shoring, favoring allies, penalizing Chinese inputs, and maybe more use of the Defense Production Act to force supply chain shifts.
And are companies already moving? Like Dell, HP.
There are reports, yes. Dell and HP apparently making plans to cut back on Chinese-made chips, and you can bet U.S. government procurement will heavily favor U.S.-built tech. Big boost for domestic vendors, especially in cloud.
Speaking of cloud, how do these tariffs hit AWS, Azure, Google Cloud, Oracle?
Well, tariffs on Chinese hardware servers, networking gear that drives up the cost of building data centers, so potentially squeezing their margins.
Do they do much business in China directly?
Not a huge amount due to existing regulations there, but they serve Chinese companies outside China, and they rely on global trade generally, and the big risk is retaliation.
Like China banning government use of U.S. cloud or software, like they did with Micron.
Exactly that kind of thing. Further excluding U.S. tech in response to tariffs or other actions. It's a real risk.
And looming over all of this, Taiwan.
The elephant in the room. Its critical role in global chip manufacturing. Any conflict there would be an almost unimaginable disruption, instantly impacting basically every tech company on the planet.
Okay, SWOT analysis time again. Supply chains and geopolitics. Strengths.
Long-term, maybe more self-reliant U.S. tech supply chains, opportunities for U.S. chip companies if Chinese competitors are restricted.
Weaknesses.
Big cost pressures from tariffs, they're basically attacks. Reshuffling supply chains is expensive and slow. Short-term shortages and delays are likely.
Opportunities.
Diversifying production to the U.S. and allies creates domestic investment, jobs. U.S. chip makers capitalizing on government Buy American pushes. Non-Chinese markets become even more vital.
Threats.
China retaliating hard, maybe banning rare earth exports. That Taiwan risk is huge. High tariffs feeding inflation, hurting consumer demand, and always the risk of policy reversal later, stranding investments.
Makes sense. Okay, let's move to AI regulation and federal funding. This sounds like another area with a very distinct Trump administration flavor.
Very much so. The report emphasizes this kind of pro-innovation, hands-off philosophy for regulating AI. But combined with strategic government investment in AI, especially for defense and surveillance, it's a real contrast to, say, the EU's approach.
So less regulation, more government spending in specific areas.
That's the picture painted. We've apparently already seen deregulatory moves, repealing Biden's AI executive order, ditching early federal guidelines on algorithmic bias and accountability. The new mantra seems to be removing barriers to American AI leadership from that EO 14179.
And that order tells agencies to prioritize innovation over precaution.
Pretty explicitly, yes.
Right.
Which has led to, prior rules seen as slowing AI deployment getting axed, like the Labor Department dropping plans for AI hiring tool audits or the CFPB pausing AI and lending regulations.
And groups like the ACLU are noticing safeguards disappearing.
They've pointed it out, yeah. Things like transparency rules, chief AI officer roles, even Biden's AI Bill of Rights principles scrubbed from websites. Now, this breakneck pace, as some call it, could raise risks, discrimination, privacy harms. But near term, lower compliance costs, fewer liability worries for AI developers.
There was also that bit about OpenAI lobbying against guardrails.
Right. The report mentioned OpenAI apparently urged the administration to pull back on proposed industry safeguards, arguing the U.S. needs to let AI train on broad data to beat China. And it seems the administration listened, No big moves to restrict training data have emerged. That's a plus for AI firms, less risk of lawsuits over their data sets. Same with licensing for advanced models seems off the table for now, unlike Europe's AI Acts.
And alongside deregulation, there's an embrace of AI for surveillance.
A strong embrace, yeah. Facial recognition, social media monitoring, predictive policing, border control AI, all seeing increased government adoption, according to the analysis.
Which brings us to Palantir. They seem like a key player here.
A centerpiece, really. Their data analysis platforms getting picked up by DHS, ICE, the Pentagon, local police. They landed that nearly $1 billion Navy software contract recently, and their stock price has jumped significantly since the election.
And past limits on this tech are being rolled back.
That's what the report indicates. Obama-Biden-era constraints, like DOJ limits on federal law enforcement using facial recognition, apparently lifted. So growth areas are things like video analytics, biometric databases, AI monitoring benefiting Palantir, but also others like BriefCam, Clearview AI.
Okay, what about the funding side? Federal investment.
We're seeing significant public-private pushes like Project Stargate, that massive $500 billion private sector plan from OpenAI, SoftBank, and Oracle to build AI data centers, announced with a lot of White House fanfare.
$500 billion. That's huge. How much is committed?
Reportedly $100 billion right away, potentially up to $500 billion over 4 years, starting in Texas. And interestingly, the executives involved apparently credited Trump's win as a catalyst for this investment. Oracle Cloud seems positioned to be a key host for these AI supercomputing centers.
And direct government funding, too, in the budget.
Yeah, Trump's FY 2025 budget proposal reportedly ramps up defense R&D for AI significantly. Overall, federal AI R&D funding expected to climb, maybe hitting $3.3 billion in FY 25, up from around $1.9 billion in FY 21. Agencies like DARPA, NSF, DOE getting boosts for AI programs.
Including that DOE AI infrastructure initiative, building data centers on federal sites.
That's part of it, yeah. Using public-private partnerships to build AI data centers at 16 federal locations. And there was even that EO about using coal-fired power for these data centers.
Coal power for AI data centers.
Seems so. Highlighting a willingness to prioritize cheap power for AI development, even over climate goals. It's a controversial angle for sure.
So who benefits from all this AI focus and funding beyond just the software firms?
Well, chip makers, obviously. NVIDIA's got huge backlogs. And defense contractors Lockheed Martin, Raytheon, Boeing integrating AI, likely seeing more government contracts.
Okay, quick SWOT on AI innovation and regulation. Strength.
Potential for faster innovation, quicker commercialization due to less regulation. Government investment provides a big boost.
Weaknesses.
Public and ethical concerns about unchecked AI. Lack of clear standards could fragment the industry. Over-reliance on government contracts could be a vulnerability later.
Yeah, opportunities.
Swift AI deployment across the economy. U.S. potentially leading global AI norms. Big projects like Stargate accelerating breakthroughs. Risk of sudden regulatory crackdown if something goes wrong with AI. Amplified data privacy and security risks. China's AI investments mean the global race is still on. And potential antitrust or public backlash against dominant AI players down the line.
Got it. Okay, last big policy area, tax and antitrust. This sounds like it could be very positive for businesses, especially big tech.
That's certainly the expectation based on the analysis, yes. Trump's economic agenda seems focused on significant tax cuts, building on the 2017 TCJA, and also moving away from the recent aggressive antitrust enforcement, generally policies Wall Street tends to like.
So the headline tax proposal, cutting the corporate rate.
That's the big one, cutting it from 21% down to somewhere between 15% and 20%. The report suggests 18% might be the target. For hugely profitable companies like Apple, Google, Microsoft, that's potentially billions in tax savings each year.
And what about deductions, like for R&D?
Also key, a pledge to restore full expensing for capital investments. That includes bringing back 100% deductibility for R&D costs in the year they happen, reversing that recent Section 174 amortization rule that tech really dislikes, plus full bonus depreciation for equipment.
That R&D change would be huge, right? Bipartisan support for that.
There has been, yes. It provides immediate tax relief and encourages more investment in innovation. Very popular with tech.
And for investors. Capital gains taxes.
Plans mentioned include cutting capital gains taxes, maybe lowering the top long-term rate from 23.8% down to 15%, possibly even getting rid of the 3.8% net investment income tax. Very positive for VCs. Individual tech investors could boost IPOs, valuations, maybe even indexing gains for inflation.
Okay, sounds great for companies and investors. The costs, though. to the deficit.
Yeah, the Tax Foundation estimated something like $4.5 trillion over 10 years, but proponents argue it could boost long-run GDP by maybe 1%. For big tech, with all their cash already, these cuts could fuel more share buybacks, maybe more M&A activity.
What about that global minimum tax deal? Does that interfere?
That's a caveat. The OECD agreement aims to set a floor. But the report notes Trump's hostility towards those kinds of international agreements, so maybe less U.S. enforcement or participation.
Okay, shifting to antitrust. A big change from the Biden era.
A significant shift anticipated, yes. Away from the aggressive stance under Lina Khan at the FTC and Jonathan Kanter at DOJ, Trump's likely FTC chair nominee Andrew Ferguson has signaled more willingness to settle major cases.
Settle cases against Google, Amazon, maybe, rather than breakups.
That's the potential outcome suggested. A softer approach, maybe focusing antitrust more on things like alleged collusion and content censorship, which is a different angle. Although the report does mention a DOJ suit blocking HPE's Juniper acquisition early in 2025, so mega mergers might still face scrutiny. But maybe easier paths for big tech acquiring AI or cloud companies.
So let's quickly run through the big five: Meta, Apple, Amazon, Alphabet, Microsoft. How do these tax antitrust changes hit each?
Okay, Apple. Big tax wins, less App Store regulation risk. But that China trade exposure is the main worry.
Amazon.
Tax benefits, likely settlement of the FTC suit. AWS might benefit from pushback on digital taxes internationally. But trade war costs are a risk for their retail side.
Maybe the
Biggest regulatory relief. That FTC breakup case for Instagram, WhatsApp looks less likely. R&D expensing helps too. Content moderation pressures might shift, though.
Alphabet, Google.
Likely settlements in those big DOJ antitrust suits. Much better than a breakup. Big tax benefits. But maybe still facing political heat or hearings on bias.
And Microsoft.
Seems very well positioned. Largely avoided recent antitrust fights. Benefits hugely from government AI cloud spending. More room for acquisitions maybe. Plus, big tax savings on top of strong cash flow.
Okay, final SWOT. Profitability and market power. Strengths.
Improved profit margins, more cash flow from tax cuts, less antitrust uncertainty lets companies plan long-term more confidently.
Weaknesses.
Potential negative public perception policies seen as just helping big corporations. And maybe relaxed antitrust stifled smaller competitors long-term.
Opportunities.
More strategic M&A. Ability to fund big long-term projects with the extra cash. Lower cap gains taxes, attracting more investment into U.S. tech stocks.
Threats.
Political backlash leading to policy reversals later. Rising national debt creating pressure for future tax hikes. And maybe a hands-off antitrust approach eventually allows monopolies that trigger even bigger regulatory intervention down the road.
All right. So, based on all that analysis, the report actually picks out 5 specific tech stocks. One seen as particularly well-positioned for this Trump 2025 agenda. Let's hear them.
Okay, number 1, NVIDIA, NVDA. Obvious AI semiconductor leader, seen benefiting from pro-AI, pro-industry policies, government spending. China sales are a drag, yes, but global AI demand is immense. R&D expensing restoration helps too. Less antitrust risk for AI M&A.
Makes sense. Number 2.
Palantir Technologies, PLTR. Prime beneficiary of that expected surveillance-friendly government AI spending. Strong alignment with the reported policy direction. Expanding into commercial AI, too, helped by deregulation. Risk is valuation and reliance on political wins.
Okay. Third pick.
Oracle Corporation, or RCL. Big cloud and data player, reported ties to Trump. Key role in Project Stargate. Minimal China trade exposure. Might even benefit from H-1B limits pushing companies to establish providers. Big tax gains, low antitrust risk. Advanced Micro Devices, AMD. The number 2 U.S. chip designer. Could benefit from reshoring efforts. Might gain share if Intel faces China issues. Government likes having a second AI hardware source. Tax cuts help too. Lagged NVIDIA recently, maybe more room to run.
And the 5th pick.
C3.ai. AI. A mid-cap enterprise AI software company, seen benefiting from the pro-AI, pro-industry stance, especially in oil and gas, manufacturing, defense. Maybe gets a boost if immigration limits push companies towards automation AI. Volatile stock, but potential upside.
Any honorable mentions?
Yeah, the report also flagged Snowflake, SNOW, CrowdStrike, CRWD, Microsoft, MSFT, and Alphabet, GOGL, as companies likely to benefit in various ways too. Strong market position.
Okay, so bringing it all together, what are the key investor takeaways? Portfolio strategy and the big risks to watch.
The report generally suggests overweighting tech in portfolios, but focusing specifically on that intersection of AI and national strategy, so semiconductors, defense tech, enterprise AI software. That top 5 list gives you some ideas.
The focus within tech.
Exactly. Large cap stalwarts like Microsoft are still solid, but maybe smaller pure plays in AI have more dramatic upside potential. Also consider cloud data infrastructure, Snowflake, Oracle were mentioned, and maybe underweight names with heavy China exposure. Always diversify, of course.
Sector weighting themes.
Overweight U.S.-centric semis, defense tech, cybersecurity seems justified by the analysis. Some talk of Maggie tech thematic baskets emerging, maybe potential in enterprise software for traditional industries adopting AI, caution on sectors with deep China ties.
And the risks. What could derail this?
Top risk highlighted is always escalation in U.S.-China conflict, especially over Taiwan. That's the big geopolitical overhang. Policy reversal in 2026 or 2028 tax hikes, antitrust getting tough again is another, and just execution risk. Maybe the agenda stalls. Tax cuts don't pass as planned. Need to be nimble, watch legislation.
What about market dynamics, valuations? Is this priced in?
Well, markets often react positively to Trump policies, and we saw a post-election rally. So some optimism is likely priced in, especially for AI stocks. Execution really matters now for those high valuations to hold. Also, watch interest rates. Big tax cuts could push them up. A balanced approach, maybe growth at a reasonable price, GARP, seems prudent.
So to wrap up, it really does sound like the Trump 2025 agenda, based on this analysis, signals a pretty distinct investing environment for tech.
It does. The themes seem to be lower regulatory hurdles, especially for AI, targeted government spending in strategic areas like defense and semiconductors, and significant tax benefits. Investors who align portfolios with those trends while staying very aware of the risks could potentially do well. It looks like an exciting, if potentially volatile, time for tech investors.
Okay, so summing up the key takeaways one last time. We're looking at potentially a very pro-business, pro-innovation tilt. Specific impacts on immigration, tightening the talent pool, trade with China likely getting more tense, AI seeing rapid deregulation but also big federal investment, and tax and antitrust becoming much more corporate-friendly. And we've identified some companies potentially positioned to benefit.
Right. That covers the main points from the analysis.
Which brings us to maybe a final thought for you, the listener, to chew on. As this landscape potentially shifts so dramatically under these kinds of policies, what might be some of the unintended consequences? You know, this rapid deregulation, this focus on American tech dominance. Could it reshape the tech world in ways we haven't even considered yet? New opportunities or maybe new challenges looking just around the corner?
That's a great question to ponder. This deep dive, we hope, gave you some clarity and valuable insights from the analysis we reviewed, helping you navigate what looks to be a complex and evolving period for technology investing.